Forget tenant headaches, plumbing emergencies, and massive down payments. What if I told you serious real estate wealth is possible without any of that? Today, we're exposing two radically different paths to real estate riches: the traditional landlord route versus the hands-off, accessible world of real estate investment trusts, or REITs. By the end of this, you'll know which strategy aligns perfectly with your financial goals and lifestyle. For years, real estate investing has meant landlord life: buying a property, finding tenants, collecting rent, hoping for appreciation. And that can be incredible. But what if it feels too daunting, expensive, or demanding right now? What if you want to dip your toes in without the enormous down payment or late-night emergency calls? Today, we're pitting the hands-on approach of buying physical property against the passive power of REITs. Let's find your perfect fit. Let's start with what most people envision when they think of real estate investing: becoming a landlord. This involves purchasing a physical property, like a single-family home, a condo, or a multi-unit dwelling, with the intention of renting it out to tenants. The goal here is typically twofold: generating passive income through rent payments and profiting from the property's appreciation over time. The upsides to this traditional approach are significant. Firstly, there's the potential for substantial cash flow. If your rent income exceeds your mortgage, taxes, insurance, and maintenance costs, you're making a profit every month. Secondly, you benefit from appreciation. Historically, real estate tends to increase in value over the long term. For instance, the average annual appreciation rate for homes in the U.S. has often hovered around 3 to 5% historically, though it varies wildly by market and specific time periods. Imagine your $300,000 property becoming worth $450,000 in a decade. That's serious wealth building. Thirdly, you get to leverage other people's money. You put down a portion, say 20% of the purchase price, and the bank finances the rest. As your tenants pay rent, they're effectively helping you pay down that mortgage, increasing your equity. And finally, there are often attractive tax benefits, like deducting expenses and depreciation. Sounds great, right? But here's what most people miss. This path isn't a walk in the park. The biggest hurdle? High barrier to entry. Buying property demands a significant chunk up front. A 20% down payment on a $300,000 home is $60,000, plus another 2 to 5% in closing costs. That's serious savings. Beyond the initial investment, traditional real estate is far from passive. You are the landlord, screening tenants, collecting rent, managing repairs, and sometimes unexpected emergencies. My friend Sarah bought a duplex, thinking it was her golden ticket. For a while, it was great. Then her basement flooded at 2 a.m. Another friend had a tenant skip rent for 3 months before eviction, costing thousands. It's a demanding job. Plus, properties are illiquid. You can't just sell a house overnight if you need cash. Markets can be slow, and selling costs money. So that's traditional real estate: high potential, high effort, high barrier to entry. But what if there was an easier way? Now let's pivot to a completely different beast: real estate investment trusts, or REITs. Imagine a company owning a massive portfolio of income-producing real estate: apartment complexes, malls, office buildings, data centers, even hospitals. Instead of buying one house, you buy a tiny fractional share of that entire portfolio. That's a REIT. They own, operate, or finance real estate, and to qualify, must distribute at least 90% of taxable income to shareholders annually as dividends. This makes them superb for regular income. You buy shares on the stock market, just like Apple or Google. The advantages of REITs are compelling, especially for new investors or those seeking hands-off wealth. First, barrier to entry is incredibly low. You can start with just the cost of one share, a few dollars to a couple hundred, no massive down payment. Second, incredible diversification. Your investment spreads across many properties, often in different sectors and locations. This significantly reduces risk. Third, liquidity. Unlike physical property, you can buy or sell REIT shares quickly during market hours. Need cash? Sell shares. Fourth, professional management. No tenant screening, no leaky faucets. Experts handle daily operations, making you truly passive. Fifth, steady income. REITs must pay out a significant portion of income as dividends, often yielding 3 to 7% or higher. It's a slice of rent from hundreds of properties without lifting a finger. However, REITs aren't without their downsides. This next part is crucial to understand. Since they trade on the stock market, prices fluctuate with market sentiment, economic news, and interest rate changes, just like any stock. You won't have direct control over properties or management decisions, a turnoff for some hands-on investors. Also, appreciation is tied to the stock market's valuation of the company, not directly a single property's market value. Finally, you might pay fees through the REIT's expense ratio, especially in actively managed funds. So, which option is right for you? It really boils down to your personal circumstances, risk tolerance, and how involved you want to be. If you have significant capital saved up, are prepared for a more hands-on role, and are looking for potentially higher direct control and leverage, traditional rental properties might be your game. You can truly build generational wealth through direct ownership, but be ready for the time commitment and the occasional headache. If you're just starting out, have limited capital, prefer a completely passive investment, or want to diversify your portfolio without the operational hassle, REITs are a fantastic entry point into real estate. They offer a way to get exposure to the real estate market's income and growth potential with the liquidity and diversification of the stock market. You can own a piece of a sprawling retail empire or a network of industrial warehouses without ever needing to inspect a roof. Many people even combine strategies, perhaps owning a primary residence while also investing in REITs for broader real estate exposure. The most important thing is to understand what each option entails and align it with your personal financial roadmap. Don't feel pressured to jump into the landlord life if it doesn't suit your current situation, especially when there are powerful alternatives available. As always, I have to remind you that this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making significant financial decisions. Your actionable takeaway for today: take 15 minutes right now to research and REIT focused on a sector you understand or find interesting, like healthcare or technology infrastructure. Look up its ticker symbol, dividend history, and what properties it owns. You don't have to invest today, but simply understanding how accessible this form of real estate investing is can be a powerful first step. If you found this comparison helpful, give this video a thumbs up and subscribe for more friendly financial guidance. What kind of real estate investing sounds more appealing to you right now? Let me know in the comments below.